Hi, this is Lex, and welcome to the Fintech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to today's conversation. I'm really excited to have with us today Jerome Le Luel, who is the founder and CEO of TRIVER. TRIVER is a really interesting fintech lending company focused on embedded finance in the small business sector. We'll talk about the application of AI to the sector, as well as Jerome's really impressive experience as Chief Risk Officer at Funding Circle UK, as well as in large global banks. With that, Jerome, welcome to the conversation.
Hi, thanks for inviting me. Very excited to be there.
My pleasure. Let's start with your introduction to financial services and to credit. What was kind of your first formative experience in this sector?
Back in 96, I'm French, but I ended up moving to the UK to live here with my family. I looked for a job and I ended up applying and getting a role at Capital One. I had no idea what financial services were about, and I didn't know this company either. They just opened an office in London. There was a team of like 12 people, and they were looking for analysts to crunch some numbers and around some financial services. I had no idea what it was about, but I got intrigued when I met the team, who was obviously very bright. And I ended up spending 12 years at Capital One. I absolutely loved it. I found a company that was obsessed about scientific methods and data and applying these tools to make financial services much better. I really got fascinated by what you learn about human behaviors using statistics and what you can do of these insights to make products better. So I was part of the launch of the first credit cards in the UK that carry this balance transfer proposition, which didn't exist at the time, and using statistics to send it to the right people at the right price to maximize effectiveness. And I saw a business growing from 12 people to 500 people in 2 years, and then to 2,000 people in 5 years. That was just incredible. I saw the power of the use of these analytics to optimize a business, automate processes, and scale very efficiently. That was a fantastic experience for me.
I can't imagine being on a rocket ship like that, especially in 1998, as the internet is about to open up. You joined before the Viking commercials and before Capital One really went mainstream, right?
Yes, very much. I think Capital One had done an IPO in the US a few years earlier. They just opened this office in Hanover Square. We were just a team of pioneers trying to reinvent credit cards. We ended up opening an operational center in Nottingham, where we ended up hiring 2,000 people and really scaled the company. Initially, the advertising was through direct mail, only direct mail. And we sent a lot of paper out there. Today, I feel a bit ashamed of how many trees have been cut in the process, but there was no emailing available. And it was a very targeted channel, which meant we could talk to the right customer, making a very specific offer without having to spend money on TV and go broad. This came later when the scale was sufficient.
Can you talk about that initial customer insight? What was that early demographic, and what was the value proposition to them that created this opportunity? And then maybe we can also talk about the marginal economics if you remember them.
The basic concept of Capital One was to say that financial services, and in particular consumer finance, was suboptimal because all customers were treated the same. And this law of averaging ends up two main issues. Number one, on the one side, you had the very low-risk customers were overpriced because they were subsidizing the riskier customers where the credit losses had to be compensated by the pricing. And on the other side, you had the riskier customers who were not offered anything because the price was too low to compensate for their riskiness. So imagine an insurance product a car insurance product where everybody would pay the same premium. That wouldn't work, right? But that was the way credit cards and loans and many financial products used to work at the time. So what Capital One did was to use data to micro-segment the market, identify those low-risk customers who were overpriced and offer them a better price. And that was this balance transfer product, which came out to help them repricing the debt and save money. And the other side, find those customers who were wrongly declined by banks because they were just not looked at in the right way and they were underserved, and offer them a product which was small limit at a higher price, but in a way that was giving them the benefit of a functioning payment product and the ability to prove themselves and then graduate into a better product over time. So that was the insight, is this micro segmentation. And for that, using lots of demographics data, but also a lot of data coming from the credit bureaus. Credit bureaus today are seen as very old-fashioned and not very good. But at the time, they were probably the best source of data to do this kind of exercise. And we went very, very deep in optimizing the value we could extract from those credit bureaus.
That's really interesting, in part because it sounds like a very modern pitch. I think there are still so many companies today that are telling the story of trying to do deep segmentation on the consumer base, of treating people the right way based on the most relevant alternative data about them, and kind of correcting for the type 1 and type 2 errors that the big banks make in painting with a very broad brush. And so I'm curious as to what you think about the progress in the industry, because you're articulating a value proposition from 15, 20 years ago that was very successful. As you say, it grew to 2,000 people in the geography. How did that bet go? And why is it that there are companies that are still articulating this value proposition?
So as far as Capital One is concerned, it's been a big success. I mean, Capital One was pretty much the very first fintech. It was like the Google of consumer finance at the time, led by people who originally were not from financial services and took a very radically a new approach to optimizing the whole system using maths and this rigorous thinking. It went extremely well. The company grew a lot in the UK, but in the US, it was obviously much bigger. And now Capital has become one of the largest banks in the US, starting from zero in the late 80s. So it's quite a success. It's been copied. I mean, many companies have tried to apply the same approach to other sectors with some success. And many alumni of Capital One have actually launched very successful fintechs all around the world. I think we've learned and we've reused this knowledge in many different ways. But there are still many areas, especially in financial services, where you don't have this right product to the right customer kind of situation. I think we all know of many things. So, for instance, over the last few years, you had FX, was known to be massively overpriced by banks because it was not priced in this way. And many fintechs came in and took away this FX business from the bank by applying this kind of rigor. Similarly, you find products in the space of banking services, corporate cards, where there was a pricing problem, and some fintechs are cherry picking those bits to optimize the market. But you're still left with a few spaces where it's not there yet, and one of them in particular, which is very close to my heart, is SME finance. SME finance is probably the most old-fashioned section of financial services, I would say. SMEs are definitely not priced in the right way and treated in the right way, and that's why I'm spending a lot of time on that these days, because I think there is a lot to do.
I want to also learn about the growing pains that you saw of scaling a company in financial services so quickly and so aggressively. What advice would you have for people who are experiencing, even a portion of that, going from 10 to 100 people is painful enough. From 100 to 1,000 is very difficult. And from 1,000 to 5,000 or 10,000 is almost, unthinkable. What are some of the lessons that have stuck to you from that early experience?
I've learned the power of having a very clear approach, making some very clear choices, and then standardizing those choices into processes that can be automated and replicated at scale and distributed across people. At Capital One, when it came to recruiting, we had a very clear view of the profiles of people we needed by types of jobs. It was documented. And against this profile, we have defined tests that people should take in order to be selected. And then the application of those tests was extremely rigorous. So it was like a machine. And once you've defined this machine properly, you can run it at scale because it's easy to train people to apply this recipe. and it worked extremely well. It's not a dumb machine; it's a smart machine that we were learning as we applied and we optimized, and like we did for the treatment to our customers, we used the same approach to how we were treating our staff. We were continually testing, learning, improving, but collecting data about those decisions so that we can make them better. This was like what you see today online when you want to optimize a website. You do A/B testing and you try different things and you make it better and better. Well, we were applying this rigorous approach into everything we're doing in the business. All the processes or the marketing or the HR, everything was done in that way. And that led to a very efficient company that was getting smarter every day. So that's, for me, the main learning is be intentional, decide from the start what you're trying to do, what you're going to focus on, what is less important, be clear about the kind of talent you need for a certain kind of job, and then be very, very sharp at executing on this vision and not change your mind every 5 minutes. So this clarity, this sharpness, I think, is what led to success.
Correct me if I'm wrong, but my guess is also there's a big difference in scaling out a company that is profitable on the margin, where every customer you get adds to the bottom line, and as you get bigger, things get better, versus trying to scale a company that is unprofitable, as a lot of recent neobanks and payment companies have been, and kind of doing it in order to generate metrics and the next fundraising round. You probably end up doing quite different things. Have you seen that be the case? Like, is there a different culture now about what scaling means, and what are your thoughts on it?
I mean, at the time, it was not a simple game either, because if you stick to this example of Capital One, we were recruiting customers using, say, direct mail. So what it means is that for every customer you book, you need to invest quite a bit of money upfront to bring them in. And then you will only recover this money if they utilize the product sufficiently over time and they pay you back with a level of default that is not too high. So you are actually making quite a bet upfront in order to get the money back. You're right, the unit economics, if they play out properly, were actually very good. We would pay back the initial marketing investment maybe after 12 months. But you still have quite a bit of money you need to invest upfront. So there was a massive financial bet behind that, which meant we had to be very careful in how we would accelerate or not the company. The acceleration was digging a hole. We used to talk about the hockey stick. You dig a hole and then the money comes back. When you look at the cash flow of a given customer since time on book, you have a big hole and then you have positive cash flow. So how you manage this curve was very critical. And what is the level of return you need to play it safe? So we were continually obsessed about this metric. And there were times when we had to slow down the business because we were burning too much. So it was not completely dissimilar to the businesses you see today. I think the difference you might have today is there are more businesses you can create where the cost to acquire is not that high because you give away freebies and you can lose online, and it could be very cheap, although not always. But I think there are businesses today where people are hopeful that they can monetize down the road by cross-selling other products without knowing necessarily upfront what this is going to be. When in this business model, we knew exactly how we would make money. It was just that customer by customer, you're never sure that you're going to get the right metrics of utilization or so on to really break even, having spent the money upfront. Capital One was not a VC-funded company. It was a self-funded business because it became accretive quite quickly. And the UK ventures I was part of got completely funded by the headquarters in the US. And over the 12 years I've spent there, they've invested hundreds of millions. So had it been a VC, I don't know if they would have made the bet, actually. It was a lot of money they put in to get to fund the asset and fund the losses due to this huge marketing push.
That's fascinating. And once you do put that money in, right, 100 million to build a brand in a geography, and then also the money to reach customers and wait through the payback period, at some point you get to scale. In your career, the next step was at scale, whether as chief risk officer at Barclaycard or as the group head of risk analytics at Barclays. Can you talk about what that transition was like for you, and what did you notice in operating at these different levels of scale and reach? Just give us a flavor, I guess, of what that vantage point looked like.
Yeah, so after 12 amazing years at Capital One, I decided to move on, and I took a job at Barclaycard, so the payment and lending business of Barclays. And I wanted to see how it works on the other side. I've spent 12 years trying to steal money away from the banks, steal business away from the banks. And then I was sitting on the other side. I was in the bank, trying to protect the bank against these new players. It was really interesting. The interesting part for me was to see what, as you said, scale gives you when you have lots of resources. You can do a lot, but also with scale comes different pace. Things tend to be a bit slower in general, which can be frustrating. So I had to learn patience compared to my previous life. But there was a very specific context in me joining Barclaycard, because I joined in May 2008 to do risk management for their card business globally. And by September, the whole market had melted. It was the 2008 recession. So even though it would have been normally a role in a slow-moving company, I ended up working at a very fast pace because there was a massive recession, and I was the guy in charge of basically extinguishing the fire. So that was a really interesting experience, which I very much enjoyed, being there at the right time in the central role of saving the day, basically with a big team. When I joined Barclaycard, I had a risk team of around 300 people. I probably hired another 500 or 600 in the following 2 years, opening an analytical center in New York, another one in India. We managed the 40 million customer portfolio around the world during this incredible recession. Nobody knew where it would end up. But the good thing is, because we deployed these techniques that I learned in my previous company, and I actually brought a few ex-colleagues with me, we could take control of the situation very well. We did a lot of testing, a very rational approach to optimizing for the situation. And we ended up turning this crisis into an opportunity. So Barclaycard grew 2x when I was there for 5 years. During the recession, we doubled the size of the business. We tripled profit. When I came in, I think Barclaycard was making around 300 million of profit, 400 million of profit, which is a big number already. And then we surpassed $1 billion of profit after 5 years, despite the recession. And this was because we had this enormous client base with lots of data, and we could do tons and tons of analysis to optimize for the treatment of every customer in the context of a recession, optimizing pricing and limits and authorizations and so on. And it ended up being very powerful. And we also pushed a lot of marketing, direct marketing, at a time when most competitors were retrenching because they were not confident enough in their unit economics. So they paused, and the market was very much for us. It's like the Booba Gump moment, when you're the only one who can go fishing, and all the other boats are back to the harbor because there is a storm, and you have the market for yourself. That's what happened, and it was an amazing experience of taking this brand, taking this scale, and in a bad context, turn it into an amazing opportunity. So at that time, I had the opportunity to work on cool projects like the launch of contactless in the UK that happened at the time. So today, if you travel on London Underground, you can beep your card. But that's a project that was led by Barclaycard, and I was part of setting it up from a risk standpoint. And another interesting project was the initiation of the point of sale finance for Apple in the US. So connecting Apple shoppers with a line of credit so that they can pay their computers in installments. Very successful business, which was later on taken over by Goldman Sachs. And I think we know the story. Goldman Sachs didn't do a good job at it, but initially it was actually very good. And this was happening in the context of a recession. So there were lots of growth, lots of opportunities, because we were a well-known brand and we were robust enough to weather this storm when many others were retrenching.
I'm going to ask you the most difficult question, I think, which is, what is risk?
So there are many definitions of that. Risk is the impact that uncertainty can have on your business. In that case, we're talking in the context of a business, right? There is uncertainty that surrounds us, and we organize ourselves. We make budgets in a company, assuming a central scenario against this uncertainty. And then the question is, what happens if reality plays out to be significantly different from the central scenario? And what would be the potential adverse impact on the business? And based on that, risk management becomes, what are you going to do to identify those risks or those deviations? What controls are you going to put in place to mitigate their occurrence or mitigate their impact if they were to happen? And how do you continually monitor and optimize those to keep the business in a given risk appetite, in a given level of uncertainty that is acceptable. That's what it is in the context of a business. Of course, we have risk in our lives that maybe take different shapes, but in a business, risk is mostly a financial risk. And then, of course, there are additional ancillary risk around reputation, regulatory issues that might happen if we do things in the wrong way. But the main risk for business is the financial risk that is the translation of all this risk eventually.
As somebody who's held these senior positions as a chief risk officer, and after Barclays, you went to Funding Circle, where again you oversaw the risk function. What's the craft of building a proper risk function for a lending business? What are the components of it, and what have you learned about setting up a performant risk function for the lending asset class?
So in the traditional world, the risk person, the person in charge of risk management, is typically the person who is there to say no. It's the person who is there to protect the business, taking a bit of a pessimistic view on things, and stop others to do silly things, and make sure they are protected in the scenarios where bad things happen. That's the traditional definition of the risk manager, which is not the one I've followed in my career at all. There is obviously, in front of risk, there is always a reward, and the two are fairly correlated. It's like when you gamble, if you take more risk, you might make more reward. And things become interested when you understand the correlation between the two, and you try to find the optimal setup to control your risk and put them at a level that you feel satisfied with while maximizing your reward. And if you can crack this equation, you can have a very significant impact on the financial success of a lending business. Because there are some interesting things going on in the lending business. The first thing is that typically when it comes to borrowing, there is a strong correlation between the propensity for people to wanting to borrow and their level of risk. So the riskier you are, the more you want to borrow. So that makes it a very tricky game, because imagine you run a restaurant. You have customers who might only buy a cup of coffee, and have those who are going to take the whole table for 10 people and a big lunch. You're obviously going to make more money with the second one. But in the world of risk, you have this difference in propensity to utilize the product. But let's say the guy who pays about the coffee is always going to pay you on time. It's fine. The guys who takes the big table might pay you or not pay you. And the bigger the table, the less chance they're going to pay you. That makes it a very difficult business to manage, right? And that's what lending is about. How do you weigh the risk and reward to get the sweet spot of people who are significantly high users whilst being low risk? How do you identify those populations that are off the norm, the average? Because that's where you get most of the profit from. Hence, the importance to do, like we did at Capital One, you want to segment the population. You want to identify those people who are low risk and high users. And they are very hard to find. You need lots of precision. And that's why statistics starts to be very helpful, because they help you extracting this population and focus on these ones. Avoid putting all your business into space where people are not going to utilize much, or in the space where people might utilize, but they're never going to pay you back. And that's the piece that I've focused a lot of my career on. Related to that, you mentioned earlier type 1 and type 2 error. That's something I'm quite passionate as well. There is this whole science around decision, which is extremely fascinating. For those who are not familiar with the topic, the challenge is at some point somebody wants a credit. They come to you for asking for credit. So it's an application. And you're going to make a decision, yes and no. And the thing you're trying to control when you say yes or no is the likelihood that they're going to pay you back or not. So you make a prediction. You say some customers are going to pay you back to a certain degree. I'm going to say yes, and some are not likely to pay back. I'm going to say no. But then you're going to, if you wait a year and you look later whether your assumption was right, you will find that you have this 2x2 where some people you thought would be good were indeed good. Some you thought were good actually bad, and then so those you thought would be bad could be good or bad. So you have these 4 buckets. Banks tend to be focused on the first error, which is the people you might say yes to, but actually turn out to be bad because they create a loss to the P&L. That's the type 1 error. Traditional risk managers tend to be obsessed about that. They want to bring down the loss rate. What they don't do much of, because it's harder, is to quantify the type 2 error, the people you said no to, so you didn't take the business, but actually they were fine. You've misjudged them. You should have taken them. And optimizing for the type 2 error is very much, I think, this is where a risk manager can excel. Because if you do that, you grow your company. You're going to approve more customers. You're going to say yes more often when they want to transact with their card. And you're going to improve customer satisfaction. I spent my career trying to apply this approach and optimizing for the type 2 error, not just the type 1, and educate my team to be very commercial and to always think risk reward, not just risk. And I think that's what helped me pushing businesses to growth.
Absolutely. I want to transition to TRIVER and maybe a bit of Funding Circle and your experience back on the founder startup side of the equation, and maybe taking that question from the perspective of what is it that a modern fintech company can do that you could not do on a large, careful, conservative bank platform? Are there types of data that you can access that provides you better capability for underwriting? Is it easier to get technology deployed? Is it just easier to get tools in place? What was that like during the first UK digital lending boom, around 2016 or so? And then what is that like now as you're focused on building out the new company?
So on the back of the 2008 recession, banks were asked to become much more prudent, much more conservative, and avoid being involved in those things like subprime mortgages that cause such a problem. So regulation becomes much tighter on banks for some good reasons. So that made it very difficult inside the bank to utilize sophisticated analytics to optimize for what I've just described earlier. All the risk models that support those decisions had to be very carefully built, but also approved by regulators, which made the lead time to change a model very, very slow. And in general, restricting to techniques that were very well known in a very conservative way. So since this time, I think banks have struggled to put innovation in that space because the requirement from regulators to be extremely conservative was there. I think that's been a very much a slowdown, a difficulty. So when I moved away from Barclays to join Funding Circle, it was quite refreshing to be in a non-bank where we didn't have these constraints and we could be more innovative in adopting the latest techniques. So at the time, what was quite new was the use of machine learning, when banks had typically built risk models over decades using logistic regression model, linear regression model. We could go and start to use things that are more sophisticated, like machine learning models, gradient boosting, tree-based models, things that have been in existence for a long time in mathematics, but they were not used by lenders. Due to some constraints of computing power, it was slow to build those models back in the 90s, early 2000s, so that they were not used too much because it was just too cumbersome to crunch. And then when the technology was there to use to run them fast, regulation made it very hard to actually adopt those models in the banks. But we could do that in fintechs, and we did with quite a bit of success. So I think that was one first thing. And the second thing is, I think moving into a place like Funding Circle, we could have much more focus. Banks have multi-products, many things going on all the time. Here we just did one thing. We did a loan to SMEs in the UK, done in a certain way, and we didn't change the product much for the 7 years when I was there, which means you can be very, very good at it. And banks don't have this laser focus, which is sometimes required to be innovative, to really get a deep understanding of your customers, of the data that is available. So it's not necessarily that we're using completely new data sources or completely new techniques, but we were just turning every stone. We were looking at every possibility. And when most banks and lenders were just missing those because they didn't pay enough attention. So this level of rigor, I think, made a big difference. For instance, we spend a lot of time digging into the data you can get from bank statements and how you can transform those bank statements into digitized OCR statements, and then take this bank data and build models on the back of it, which were very powerful. Banks have this data in their databases every day already, but they're not using it much because nobody really took the time to see what you could extract. And we had lots of success when we focused on it full time. And then we got lucky because regulation changed and banks were forced to share their bank data through open banking. And the models we had created using bank statements were actually applicable immediately to open banking, which was making things even easier for the customer. And that gave us another boost. But I would say it's the combination of having fewer regulatory constraints, being much more focused, and having this kind of insistent quest for the next little thing that is going to make the business better, instead of just being satisfied with an average result.
I think so much of it does come down to entrepreneurship and incentives and incentive alignment. And despite designing all sorts of compensation programs, I just don't think you can bottle up the drive that you get out of having a small team with equity upside going against a Goliath and a difficult problem. That motivation, unfortunately, I don't think you'll ever be able to generate that inside of an organization that's really trying to maintain and defend its turf. And that's probably how it should be. It's probably the right thing that there are, some people that are explorers, and then once they've established a beachhead and built something new, then it gets incorporated into the previous empire. But probably you do have to have that different spirit and a different structure to get there.
That plays a role, definitely. But also beyond that, when you're not a bank and you're a fintech and you have this kind of younger, cooler atmosphere, you attract people who would never work for a bank. So lots of my colleagues who are brilliant at Funding Circle, they would have never considered working for a bank. For them, it was a complete nightmare. Even though they never tried, they don't want to go there. But because you're not a bank, you can get this talent, and those people are amazing, and they bring a fresh perspective, and they help you innovating. So even if they are actually contributing to making lending better, they don't view themselves as working for a lender, and that's fine by their values. So it's just different kind of people you get in. Another thing that plays out when it comes to innovation, very often good ideas don't happen because they're killed the kind of junior level in the organization. I've seen that in some banks. Somebody comes up with a good idea, and it's trialed a bit, and then it goes to one level of management, and then the next level, and then at some point it gets deprioritized because so many other things are happening, and the organization changes all the time, and it just gets swept away. In a smaller organization like Funding Circle, the CEO would see directly this idea and would sponsor it. And that changes everything. You don't pose the idea just because there is a new flavor. It's if it's deemed to be a great product improvement, it's going to be brought to completion. And that protects innovation from being killed by the generic prioritization process that exists in any large organization. So I think this is the issue of large organizations, where good small ideas disappear before they have a chance to be sponsored by somebody who can protect them over a sufficient period of time.
I think it's very structural. There are few answers you can get to that solve that. So let's land on TRIVER and the current thesis that you have about small businesses and underwriting them, and what is the approach you're taking now? What are the new tools you have now that weren't there before, and how's it going?
So having spent 7 years helping small businesses at Funding Circle, offering them loans over like 5 years duration, I really learned about how to support them, but also I've learned about the pain points they have. And I found that beyond having financing for medium term, they also have another pain point, which is financing for the very short term, cash flow finance. And I thought this is another nut to crack, which is very interesting. So when I decided to move on from Funding Circle, I thought, okay, this time I would try to solve this other problem. And I did some research about the market, and I found that indeed it was a very big problem. When you survey SMEs, they tell you that cash flow management, short-term cash flow management, is the number one pain point. It keeps them awake at night because the worst nightmare for a business is to run out of cash. They can't pay suppliers, they can't pay staff. It could kill their business. It could make them look really bad, damage relationships. So it's a very emotional topic. It's not just a practical topic. And businesses, unfortunately, don't have a good solution to that. The reason why they don't have a good solution to that is that they would normally have turned to their bank. But banks, in the world of SME, have not found a way really to automate credit decisions. Banks have automated consumer finance decisions in a large way. They've done good progress automating mortgages, algorithmic trading, all these good things. But SME finance, they've never really invested the time and effort to automate. So it's done manually. Every time an SME wants some form of lending, an underwriter would look at it and judgmentally decide yes or no. This is not great because the process takes time. There are lots of type 2 errors because human beings made lots of errors like that. But also it adds a lot of cost to the system. So if you go to your bank and you want to take a loan over multiple years, a big loan, the cost of the underwriter at the beginning gets absorbed in the overall cost of the product. That's fine. But if you want to have a short-term loan or a bank overdraft or some borrowing for a few weeks, the money you're ready to pay is not sufficient to pay for the cost of this underwriter who needs to spend a few hours looking at your demand, which means banks don't really offer those products. Or if they do, it's very expensive and it's not a good experience. So if you take the example of invoice factoring, for instance, if you go to your bank, typically in the UK as a small business, and you want an invoice factoring solution to solve your short-term cash flow problem, it will probably take around 4 weeks for this invoice factoring facility to be open to you if you are approved. And then every time you're going to submit an invoice to be financed, it might take 2 days. I mean, this is not the time scale that small businesses can live with. Small businesses have things happening every day. They need to move much faster. So it just doesn't work for them. And that's why small businesses make very little use of invoice factoring. Percentage of small businesses in the UK using it is less than 10%. When large corporations use it a lot, 30% of them use it because they have a financial team that can deal with all the complexity and they have time to set it up properly. And alternative solutions like bank overdraft or so on are not that easy to get either. So small businesses don't really have a solution to solve this problem. And I thought, well, a problem without a solution because of a bad manual process behind is a great thing I want to go after because I know how to use data science to automate decisions. I've done my whole career, I've spent doing that. So I thought I could apply this know-how to fix this huge problem, which would help the economy and help lots of entrepreneurs. So that was the inception of the idea. The other thing that told me that it was the right time to do it now is open banking. I've mentioned the emergence of open banking over the last few years. It started as a public initiative. It took a few years to convince banks to actually do it properly and for the public to accept that this was a safe way to share your information with who you want to share it with. And now I would say it is ripe. Most people feel comfortable that open banking is okay to use either personally or for their business to share data in order to get a better service. And TRIVER uses open banking connection to have a read-only access to the data of businesses, which enable us to data mine this data, understand the business financials much better than we could using their actual reported financials because it's much more granular. And from that, run algorithms that predict the likelihood for this business to do well in the coming few months with a very high level of precision. Hence, we don't need a manual underwriter because the model is strong enough. Hence, we can provide the service instantly. We can do it 24/7, which does not exist in that space. So I'm thinking this is such a revolution that from there, many use cases can be supported. This platform we've built that delivers what we call instant capital in a click can be consumed by APIs. So now many businesses can choose to offer instant capital to their SME clients as an embedded solution through an API and not having to go through this complexity that we've dealt with. That's going to be a massive change in the way SMEs can get financed at the point of need, but also it means that many non-financial institutions can now provide very helpful short-term finance to their clients without having to be a bank or even working with a bank.
That's really interesting. And two things kind of stick out at me. First, the go-to-market around embedding the technology. And then the second is around the algorithm. And there have been companies that have tried to build automated underwriting models that send capital around to small businesses, things like lighter capital that ingest financial statements and so on. But you're saying that you're able to go down to the transaction level and out of that build kind of like a real-time P&L and then have that drive to an underwriting decision?
Yes, exactly. The bank data is very interesting because it's the most universal you can find about businesses. Every business has a bank account and they have bank data in it. And it looks pretty much the same everywhere. You need some data engineering, but it's pretty good as it stands. And from there, you can learn a lot about the business P&L, but also you can recreate their cash flow. You can also have good insight on their balance sheet because you see loans and capital expenditure as well. And what makes it even stronger is when you combine this bank data with the data you can get on the same business from the credit bureaus. So the conjunction of the two, and then the insights you get from Companies House about the formation of the business, some general information about their shareholding and so on, means you have a very good 360 view of this business, which gets refreshed continually. And that's quite new. And we found that we train models that are very robust when you combine these pieces together. So I wouldn't say that open banking on its own solved the problem. I think open banking was the missing element to enable automated underwriting for SMEs in conjunction with the other sources I've mentioned.
What are the different sides of your supply chain? Where does the capital come from? And then how is it consumed? It can be real time. It can be put into different platforms, but like what's a persona of a target company to underwrite and where would they access that capital?
Yeah, so let me explain a bit how the product actually works. So I have one of my clients, Jacqueline, she's amazing. She has a business in the UK where she provides staff to the farming industry, to those companies, industrial farms where they raise poultry, chicken, and she sends staff to collect those chicken manually and put them in boxes and so on. And for that, she has 20 people and they need to be paid on a weekly basis. But her client would pay her after 60 days and sometimes a bit late. And that's a real difficulty for her because she needs to pay staff on time, obviously. And she has this continuous issue. And if her business grows, the issue gets bigger. The working capital need gets bigger. So with TRIVER, she could log on our platform online, apply in a few clicks. We only need from her some very simple information about a business and a connection to open banking to then be able to open a facility for her. And once this facility is open, immediately she can upload an invoice from this client's big farm and get this invoice paid to her to their bank account immediately using faster payment. So the end-to-end process, opening the account and paying the first invoice might take altogether 30 minutes, which is really fast. And it works 24/7. When she gets paid by this big company, then we would direct debit her bank account to get our money back with our fee. And we only charge a simple fee per transaction. So it's very simple, very transparent. And then she can do that again and again. Within this limit, she can put more invoices, repaid invoices, use it again. It's an open-ended facility that she uses when she wants. There is no obligation. It's pay as you go. And it's a very flexible solution that it's a bit like a bank overdraft, but you have a real limit and it's already there and it has nothing to do with your bank. So customers like it. It's very discreet. Clients, suppliers don't know about it. It's their decision. So it gives them lots of empowerment and lots of freedom to do what they want. On our side, the way it works for us, when she goes to the platform and she does these things, we pull data from different data sources and we run algorithms to make decisions. And we have a tech platform to process this application. And then when the facility is created, we have another tech platform to process, to compute the lending, calculation of the interest and everything automatically. We have a customer service with a CRM and we have the whole thing and we can do collections, recoveries. Everything is in-house. When it comes to the capital, I raised equity from various VCs. I raised 7 million of equity last year. And I also raised debt, asset-backed debt, 20 million. So this debt is attached to the portfolio of lending, of invoices lending that we are creating. And it allows me to expand the liquidity I have available to help those businesses. And as my business grows, I will raise more debt and more capital backed against this asset that yields sufficient revenue to pay for the cost of debt and extract a margin. It's a fully sufficient, self-sufficient capability. We are not a platform, a peer-to-peer platform or anything like that. We are a financial institution that delivers the full package. That means that we can then partner with non-banks and give them access to this mechanics with an API. And they don't have to take any credit risk, any capital. We take care of everything. It's just a plugin. They can choose to integrate more or less depending on their preference. We have an option where it's just a click out, and we have an option where it's an API, and depending on how much they want to invest in the exercise, they can do one or the other, or start with one and then do the other. But the idea is that we're bringing finance to non-financing partners because we have the whole package available.
That's really interesting and definitely a clever distribution mechanism, because there are so many consumer footprints that are looking for more revenues and more financial products to offer. I've really enjoyed our conversation, and for our listeners, I'm curious that if they want to learn more about you or about TRIVER, where should they go?
Our website, triver.com, will give more information. They can always ping me directly, jerome@triver.com. We are currently looking for more partners who would like to embed our technology, and we are welcoming companies that have SMEs in their portfolio in the UK, because for now we're focusing on the UK, but we're very open to many sectors. We're currently in conversation with banks, procurement software companies, accounting software, FX platforms. There are lots of use cases we can support. We would love to hear about your needs. So feel free to reach out.
Wonderful. Jerome, thank you so much for joining me today.
Thank you for inviting me.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things FinTech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.